All right, in this video, we're diving into the question on every investor's mind. Why are long-term interest rates climbing even as the Fed has started dialing down recent rate hikes? The 10-year U.S. Treasury yield recently jumped over 4.4%, driven by solid economic data and anticipation around the presidential election. Interest rates ripples across all corners of the financial landscape. They impact what households pay on mortgages, credit cards, and auto loans, while also boosting the yields in your savings account and CDs and other fixed income instruments. So stick around to uncover the forces behind these interest rate shifts and, most importantly, what they mean for your investment strategy as we head to the end of 2024. Higher interest rates pack a punch across the economy, especially when it comes to business growth. They push up the cost of borrowing, which can lead companies to hit the brakes on hiring, slow expansion plans, and take a hit on profitability. As you see from the chart, economic growth stayed solid last quarter thanks to robust consumer government spending, with some economists raising eyebrows over a possible slowdown. There is a question mark around whether this momentum can keep up. The job market, too, is sending mixed signals. While September's strong job report hinted at the Fed's desired soft landing, a gradual economic slowdown without recession, October numbers weren't as bright, with only 12,000 new jobs added. So as we close out the year, investors are watching closely to see if this delicate balance holds steady. October's job report brought the lowest monthly job growth since 2020. But before sounding any alarms, keep in mind that strikes and hurricanes last month likely skewed the data. Take a look at this chart. It tracks job creation since 2000, showing that while October's numbers were softer, the overall trend has still been pretty impressive. In fact, the job market remains resilient, with 2.2 million jobs added over the past year and unemployment holding low at 4.1%. As inflation starts to stabilize, the Fed's focus is shifting towards employment metrics, making the labor market a key piece of the interest rate puzzle. This steady economic growth could be one reason why we're seeing long-term rates inch up, even as short-term rates ease with recent Fed cuts. This dynamic often creates a steepening of the yield curve, which is typical in early economic cycles. It's still unclear if this trend will continue, but investors should keep perspective and avoid overreacting to short-term rate changes. All right, let's close while talking about the wild ride in the bond market this year. Different bond sectors are delivering dramatically different results. High-yield bonds are up an impressive 7.5%, while munis are only managed up 0.8%, all thanks to uncertainty surrounding interest rates. Now let's check out this chart. It ranks bond sector returns from best to worst for each year since 2008. The takeaway? No single sector is always a winner, making diversification a key strategy in the bond world, just like the equity world as well. Adding to the appeal, many bond sectors are currently offering yields above their long-term averages. Treasury bonds, for example, yielding 4.3%, and investment-grade corporates are yielding over 5%. Bonds play a crucial role in portfolios, not just for generating income, but for also balancing out your risk. While the future is never a sure thing, a diversified fixed income portfolio can help protect against the ups and downs while letting you benefit from today's favorable yields. And we've only just started digging into the potential here. If you want to explore how to make the most out of current bond yields and manage interest rate changes, reach out. I'd love to continue the conversation.